Hey guys, John from Gutenberg Research here, and in this video I'm going to take you through the changes that I made to our Netflix Inc. earnings model. And this would be to include the fourth quarter results as well as the guidance that management provided on the conference call tonight. And there are two main adjustments that I had to make. So one is related to the subscriber growth, and the subscribers came in well ahead of what we were modeling for the fourth quarter. But the guidance for the first quarter of next year is a little bit lower than the growth rate that was implied by our subscriber count. And that's really because the base is much higher than we had anticipated. So I'm going to be adjusting those growth rates down just a bit. And then the other thing is the contribution margin for both US and international. The guidance is much stronger than what we were anticipating. So for example, on international, we were expecting to break even from a contribution margin standpoint at some point in the third quarter of 2017. That's what we were modeling prior to tonight's release, but management gave guidance that they'll actually be profitable in international streaming next quarter at 1.5% contribution margin. So I'm going to make adjustments for both those items as well as a few other things, and I'll walk you through those changes now. So for this analysis, we're going to need the letter to shareholders, and that's where management's guidance is. So if you just go to the Netflix Investor Relations page, you can download this for yourself. And you can see here this column gives their forecasted guidance for the first quarter of 2017. So I've already input these items into our consensus-based earnings model, and I've left some comments. So I'm not going to toggle back and forth, but if you want to download the model yourself, you can just check these numbers here. So to download it, visit our website, gutenbergresearch.com. If you click on the Netflix page, you can see that we have both a Tier 1 and a Tier 2 model available for free. I'm going to click on the Tier 1 model. The only difference between the two is the Tier 1 also models the balance sheet and cash flow statement and uses both a discounted cash flow and a price to EBITDA multiple valuation. So the Tier 2 model is a much more simple version. It's really just modeling out the earnings only and not the cash flow or the balance sheet. And I am going to freeze the panes here. So before I do freeze them, you can see the color code. Anywhere you see the blue cells, those represent our primary estimates. Purple cells represent management guidance, and orange cells represent consensus estimates. So prior to tonight's release, this was actually calibrated to meet the consensus estimates for top line revenue and bottom line EPS. And when we did that, our price to EBITDA valuation was $130. And our DCF valuation was $132. So our total valuation using a 50-50 weighting of the two approaches was $131. So you can see now that I've updated the earnings here, the price target has moved up to $142. And that's a little bit below what the shares are doing in after hours right now. And I think that's just because I'm really only adjusting the first quarter of 2017. And then I've left the growth rates constant for the rest of 2017. And if I was putting my own adjustments in here, I probably would change those a little bit, but I'm going to leave that up to you. You can download it and do what you will with it. And then again, after tomorrow, I'll recalibrate this to the new consensus estimates. So let's get right into it. So I'm going to skip down below the income statement to where our segment details are, and the segment details basically feed the results up in the income statement. And these purple cells represent the guidance. So just to show you how that works, for the domestic streaming business here, you can see I put a little comment. Management guided US paid members to 49.86 million on 1/18/2017. So just to show you how it works, let's go back to this shareholders letter. And if you look to the US streaming paid members, 49.86. So that's where I'm getting all of these numbers from. Let's go back to the model here. So a couple of things I want to point out, some changes that I made. Prior to this release, our growth rate, we were modeling paid member growth quarter over quarter of 5%. And you can see I had to bring this down to 4.1%. And that's really just a function of the fact that we ended the fourth quarter of 2016 much higher than we had originally anticipated. And you can see that the guidance before was 47.6 million subscribers. So it came in well ahead of management's guidance. And now I've just calibrated this growth rate to meet the new guidance that management gave us tonight. Then in terms of average revenue per user, you can see I actually had to bring this up a bit. So I was modeling $29 per user prior to tonight's release, but in order to get back to management's guidance of 1.47 billion, we had to increase that to 30. And this is one of the things that I think if you want to take some opinions about the rest of 2017, you can see I was modeling flat $29 per user right through the end of 2017. But you may look at this and say, okay, back in June of last year, they were at $26 per user, ticked up to 27. December, the lower rates, the grandfather of the lower rates started to phase out, and now they're expecting it to reach 30. So if you want to make your own opinion here, you might change all 3 or all 4 quarters of 2017 to 30. But again, I'm only going to change the first quarter of 2017 based on management's guidance. I want to keep everything else consistent for now. So then we get to the margin item. So the way this works is we have a gross margin estimate, and then we have a marketing or average marketing expense per member. And so the way to think about that is how much does it cost to get new members as well as keep the existing members that they have. So prior to tonight's release, I was modeling this at about $2. Then I looked at the first quarter of last year, and it was $1.80 in the United States, which had come down a bit from the fourth quarter of the previous year. So it came down 10 cents. I thought that was appropriate to bring it down a little bit just because the contribution margin for the United States was higher than what I had originally expected, and I needed to get back to the guidance of 41.3%. So I brought that down a tick, and then I had to really ramp up the gross margin in order to reach this contribution margin of 41.3. So obviously this could be a mix of the gross margin and the average marketing costs, but I felt like $1.80 is reasonable, and I just plugged the rest to gross margin. So you can see, in order to meet this contribution margin of 41.3% for the U.S. streaming business, they actually have to have a pretty healthy gross margin, well ahead of where they were all of last year. So I think this is probably one of the main takeaways from tonight's release. Next, let's take a look at the international streaming business. So that is this section here. And the methodology mimics what we saw in the US streaming business. It's reported pretty much the same way. Now, starting with the total paid member quarter-over-quarter growth rates. So prior to tonight's release, I was modeling this at growth of 12%. But now, because we have a higher base in the fourth quarter of 2016, I actually had to bring this growth rate down to 10.4% in order to reach management's guidance of 45.5 million. So I did that, and then I had to change the revenue per member from $24.70 to $24.10. So I had to bring that down 60 cents. Not a big deal there. That gets me back to management's guided revenue of just over $1 billion. And then again, as I mentioned at the beginning of this video, the contribution margin is expected to be positive 1.5%, which is great. So in order to get there, I brought the marketing cost per member down from $450 to $380. And I brought the gross margin up to 17.3%. So that's well ahead of where they were in the fourth quarter. So this management did say the results are a little lumpy, so it's kind of hard to tell what exactly is going to happen in the first quarter of 2017. Maybe they pulled forward a bit of that subscriber growth, but honestly, with these contribution margins where they are, I think it probably justifies an even higher price than what this model is implying at this point. So there's not really much else to the model. There's the domestic DVD business is basically in runoff, so I didn't make any changes there. I did have to change the technology and development expense and G&A just a bit to get back to the 9.1% operating margin that management guided. And that was really it. I didn't change anything else in here. I changed the tax rate slightly. And that was it. And you can see even with this, I'm still only getting back to 35 cents a share. So I could really increase this an extra 2 cents. In fact, I'll make that adjustment after this video just to get back exactly to what management guided the EPS to. But even where it stands right now, the valuation is still, $10 higher than what this model had implied based on the consensus estimates prior to this. And also FYI, we're not using a price earnings model multiple anymore. It's actually a price to EBITDA, which is of course before that's before tax anyway. So if we change the tax rate in the EPS, it's not going to actually impact the multiple valuation here. So that's the rundown. Definitely check back tomorrow after the consensus estimates are out, and I will update this model. And while you're on our website, check out some of our other users. So we have 3 contributors to our Netflix models right now. So we have Ross Griffiths, who's a professional contributor out of London. And then we have Brandon Smith and Eric Lee, 2 intern users, and they each have their own models here. And then if you would like to submit your model, you can basically send it in to me. I'll take a look at it, and I'll post it here with your summary of why you made changes the way you have. Thanks for watching, and good luck with the rest of earnings season.